Today, we will talk about home bias, what it is, how it works, special considerations. Home bias refers to the tendency for investors to invest the majority of their portfolio in domestic equities. This means they are ignoring the benefits of diversifying into foreign equities. Investors might do this because investing in foreign equities can be more difficult due to legal restrictions and transaction costs. Others might just prefer to invest in what they are familiar with rather than moving into the unknown. Home bias generally occurs within equity markets and is believed to be driven by emotions rather than objectivity. Investors with home bias tend to be more comfortable investing in what they're familiar with. This means they'll invest in the stocks of domestic companies rather than those in foreign markets. Factors like the proportion of global market that U.S. equities represent and the different behaviors of generations can lead an investor to favor domestic investments. Investors often have a country-specific view of systematic risk. For them, investments in foreign equities tend to lower the amount of systematic risk in a portfolio. This is because foreign investments are less likely to be affected by domestic market changes. It is important to consider the interconnectedness of different economies due to globalization when investing in foreign equities. Home bias has historically been fueled by the lack of available options and greater barriers to entering foreign markets. However, mutual funds and exchange-traded funds now provide easy and low-cost ways to diversify across international investments. Diversification aims to maximize returns by investing across different areas to lessen the chance that a market event can have a debilitating effect on an entire portfolio. It helps reduce risk by allocating investments among various asset types, geographic regions, and industries. Some foreign markets tend to be less closely correlated with domestic performance, which can help protect investors against losses due to changes in the domestic economy. However, economies around the world are becoming more intertwined due to globalization, and a downturn in one economy can impact others. It's important to consider these factors when investing in foreign equities to achieve true diversification. Investing in foreign markets can be tax beneficial depending on the tax laws of the country being invested in. Many countries create beneficial tax laws for foreign investors, particularly for investors in developed nations. U.S. investors still have to pay taxes on profits earned abroad but may be able to benefit from the foreign tax credit to reduce their tax liability. Here are 5 key takeaways. 1. Home bias is an investor's preference to invest primarily in domestic equities rather than diversifying with foreign investments. 2. Transaction costs, inaccessibility, and unfamiliarity with foreign equities were reasons for investors to have a home bias. 3. Some generations may be more likely to exhibit home bias over others. 4. Home bias affects individual investors as well as experienced and professional investors, such as mutual fund managers. 5. Investing in foreign equities is now easier because of the availability of information as well as investment vehicles like ETFs. Hope this would help. Thanks for watching.